The US economy added just 22,000 jobs last month. Let me say that again, 22,000. That's not a typo. That's a fraction of what economists expected, and it's one of the biggest red flags we've seen for the economy in years. You've probably been hearing the phrase labor market cooling all over the news. But what does that actually mean for you, for your job, for your savings account? Is this the signal that a recession is closer than we think? And more importantly, how do you prepare? Today, we're cutting through the jargon and getting straight to the facts. We're doing a full US labor market cooling explained breakdown. We'll look at the latest jobs report, uncover why this is happening, and reveal what it could mean for your wallet. Stick with me, because by the end of this video, you will have a clear, actionable understanding of the situation. So let's start with the headline numbers from the August 2025 jobs report, because they tell a stark story. As I mentioned, the economy added only 22,000 jobs. To put that in perspective, the average monthly job growth in 2024 was around 168,000. In the last 4 months, that average has plummeted to just 27,000. This isn't just a slowdown, it's a near standstill. Simultaneously, the unemployment rate has ticked up to 4.3%. That's the highest it's been since 2021. Now, you might hear that 4.3% is still historically low, and that's technically true. But the direction of the trend is what matters to us here at Smart Money Sense. It's been gradually climbing, and this latest jump is a significant signal. So, what is a cooling labor market? It's exactly what these numbers describe. It's a transition from a hot market, where jobs are plentiful, wages are rising fast, and workers have the upper hand, to a cooler one. In a cooling market, hiring slows down, job openings decrease, and wage growth starts to moderate. We're seeing annual wage growth cool to 3.7%, a noticeable drop. Think of it like a pot of boiling water. For the last couple of years, the labor market has been at a rolling boil. Now, someone has turned the heat down. It's not cold yet, but the bubbles are disappearing and the steam is fading. This is the essence of a softening job market. And if you're finding this explanation helpful, do me a small favor and tap the like button. It's a free way to support the channel, and it tells the YouTube algorithm that this is valuable information that more people should see. Thank you for that. Okay, so the market is cooling. The next logical question is, why? This isn't happening in a vacuum. There are a few major forces at play. First, and most importantly, this is the intended consequence of the Federal Reserve's actions over the past couple of years. The Fed raised interest rates aggressively to fight high inflation. Higher interest rates make it more expensive for businesses to borrow money to expand and for consumers to buy things on credit. This reduces demand across the economy, which in turn is supposed to lead to slower hiring. The Fed essentially decided to accept a cooler job market as the price to pay for getting inflation under control. It looks like those rate hikes are finally having their full delayed effect. Second, there's a growing sense of economic uncertainty. Businesses are hesitant to hire when they're unsure about future demand. The threat of tariffs, geopolitical tensions, and mixed signals about consumer spending have made many companies press pause on their expansion plans. A recent survey showed that nearly 20% of U.S. firms plan to slow hiring in the second half of 2025. They're taking a wait-and-see approach, which directly translates to fewer jobs being created. And third, we have to talk about the data itself. The Bureau of Labor Statistics recently issued a massive downward revision. They announced that the economy had created 911,000 fewer jobs in the year ending March 2025 than they had initially reported. This tells us the labor market was already significantly weaker than we thought, and we're just now getting the true picture. This isn't a new problem. It's the realization that the problem is bigger than we knew. This brings us to the Federal Reserve and the critical question of a Fed interest rate cut. The Fed has what's called a dual mandate: to achieve maximum employment and to maintain stable prices, which they define as 2% inflation. For 2 years, their focus has been entirely on the stable prices part. Now, the maximum employment part is flashing red. The weak August jobs report has put the Fed in a very difficult position. On one hand, inflation is still stubbornly above their target. On the other hand, the labor market is weakening much faster than they likely anticipated. If they keep interest rates high to continue fighting inflation, they risk tipping the economy into a full-blown recession with significant job losses. If they cut rates to support the labor market, they risk letting inflation get entrenched. This is the delicate balancing act they face. However, the latest data has tilted the scales dramatically. The market is now pricing in a very high probability, over 90% in fact, that the Fed will cut its benchmark interest rate at its next meeting on September 17th. Why? Because a U.S. labor market cooling explained in Fed speak means our policy is working, maybe too well. They are seeing clear evidence that the economy is slowing, which reduces the need for restrictive high interest rates. A rate cut would be a dovish pivot, a shift from fighting inflation to supporting economic growth and employment. The question is no longer if they will cut, but by how much. Before we get to the most important part, what this all means for you, if you're serious about making sense of the economy and your money, make sure you subscribe to Smart Money Sense and hit that notification bell. We release videos like this every day to give you the clarity you need. Alright, this is where Wall Street meets your wallet. What a cooling job market means for you depends on your personal situation, but here are the key areas to watch. First, job security. In a hot labor market, it's easier to find a new job or get a promotion. In a cooling one, the power shifts back to the employer. Companies become pickier about who they hire, and layoffs become more common. We're already seeing that youngest workers and recent graduates are feeling this shift the most. If you're currently employed, this is a time to focus on being a valuable member of your team. If you're job hunting, be prepared for a more competitive environment and potentially longer search times. Second, your income. With hiring slowing down, the pressure on companies to offer huge wage increases diminishes. As we saw, wage growth is already moderating. This means your raises might not be as generous as they were in the past couple of years. This makes budgeting and managing your expenses even more critical. Third, your investments. Here's where it gets interesting. A cooling labor market and the resulting expectation of a Fed interest rate cut can actually be good news for the stock and bond markets, at least in the short term. Lower interest rates make borrowing cheaper for companies, which can boost profits. They also make stocks look more attractive compared to safer assets like savings accounts. Sectors that are sensitive to interest rates, like technology and real estate, could see a rally. Bonds also typically perform well when rates are falling. However, there's a huge but here. If the labor market cools too much and the economy does enter a recession, corporate profits will fall, and that would be bad for stocks. This is the recession risk 2025 everyone is talking about. It's a tug-of-war between the positive effect of lower rates and the negative effect of a slowing economy. So, how do you position yourself financially in this environment? This isn't about panic, it's about smart preparation. First, build up your emergency fund. In an uncertain job market, having 3 to 6 months' worth of essential living expenses saved in a high-yield savings account is your #1 defense. This is your personal safety net that allows you to make decisions from a position of strength, not fear. Second, review your budget. With wage growth slowing, it's a good time to get a firm grip on your cash flow. Know exactly where your money is going and identify areas where you can cut back if needed. Third, stay the course with your long-term investments. Don't try to time the market based on 1 or 2 jobs reports. A well-diversified portfolio is designed to weather economic cycles. If you have a solid plan, stick to it. Market volatility can be an opportunity to invest at lower prices, a strategy known as dollar-cost averaging. Finally, keep learning. The more you understand about what's happening in the economy, the less anxious you'll feel, and the better your decisions will be. That's the entire mission of this channel. So that's the clarity behind the US labor market cooling explained. We've seen that job growth has slowed to a crawl, the unemployment rate is up, and the Federal Reserve is likely to respond with interest rate cuts. This brings both risks to the job market and potential opportunities for investors. Now you have a clearer picture of the situation. But I want to know what you think. Leave a comment below with your biggest question or takeaway from today's video. I read every single one. And if you're ready for the next topic, click the video on your screen now. Subscribe to join the conversation and keep building your financial sense. See you in the comments.